Yeah. Well, good morning. This is Rich Morrison, and welcome to this month's edition of the aftermath. We got a lot to talk about today as far as the reports yesterday, so we'll dig right in. First, before we do that, let's start off with a quick look at the livestock market because it is, we've got some markets at all-time highs are really, really close. The feeder cattle market back up again. I didn't update the chart this morning. We're higher again this morning, so we may be pressing last week's highs here today. And I thought this was an interesting chart. Someone else gave me the idea of it, but when you look at the feeder cattle to corn ratio right now, it's running also at a record high. So I know a lot of cattle folks are trying to make decisions on keeping feeder cattle versus selling them, and this kind of adds to the decision-making process, I guess. The live market continues to push high as well. We're near a record high this morning. We were back up a couple dollars today, so we'll see if that what happens here going forward. So with that, let's dig right into the grain markets and what happened here the last couple of days or yesterday. First off, corn. We saw a rare report where USDA raised acres and they raised the yield number most significantly. I think I saw this morning since 2005, there had only been 6 years where USDA changed the acreage number in August, and this was the only year that they raised it. So the other years they had lowered the acreage number, mostly because of prevented plant or something like that. So the report yesterday, USDA did take into account the FSA certification acres from back in July. So say what you will, but they did at least do that part of it. So you can see 97.3 million acres. I don't think that's a record, but we're awfully, awfully close to the highest we've been in many, many years. And as far as the corn acres to final. Now, this isn't final yet, but if it were final, this would be the biggest jump that we've ever seen. So from June to the final numbers. So there is a chance USDA can come in later and lower the acres. Usually they would wait till January to do that. So we'll see what happens as we go forward. Then you look at the yield numbers yesterday and going into the report, these were the crop ratings. I think we were still 72% good to excellent on Monday afternoon. So the highest crop rating we've seen in many, many years. The corn yield yesterday, a whopping 188.8. We haven't been above the trend line in 3 or 4 years. And now here we jumped way above the trend line with yesterday's number. Arlen Suderman. Arlen caught a lot of flack last week when StoneX put their number out. They were at 188.1. Everybody wondered what the heck they were talking about. They ended up being really, really close to the USDA number. But he mentioned last night that that USDA had raised its corn estimate 17 of the last 32 years. And then in January, it was only higher 5 times, but they lowered it 11 times. So there's been at least a history of in those years where USDA raised it in August, they tended to bring it back down a little bit by the final number in January. So I know there's already a lot of people on Twitter and everything talking about that this will be the highest number we see all year. History would kind of tell us that might be the case. Looking at the state numbers yesterday, these are versus a year ago. So the blue states are all above last year. The red states, pink states, a little bit below last year. Anything with a pound sign is a record. So you look through the central part of the Corn Belt, the 3 I states, Missouri, Wisconsin, Minnesota, South Dakota, all record numbers, Tennessee, Virginia. So we got a lot of record state yields in that report yesterday. And again, it's just the August crop report. We've got September, October, November. We skip December, and then January will be the final one. So we've still got several opportunities for USDA to make some changes. Production is a record. with the near record acreage number and a record yield, 16.7 billion bushels. That number went up more than 1 billion bushels from last month. I don't think that's ever happened before, that you've seen 1 billion bushel increase from one report to the next. So that's just an incredible increase. And you can see here where the production number came in relative to all the trade guesses. The trade estimates are all down in blue. The StoneX number was right here, and they were using the previous acreage number. So you throw in this high yield with the new acres, and you can see why it was way above all trade estimates, and certainly why it was a bearish number. So as we look at the balance sheet from yesterday, first off, if you look at the old crop balance sheet, USDA made a few tweaks. They lowered ethanol demand, raised exports to match what we've been doing in sales, which took ending stocks down a little bit, down to 1.305 billion bushels. Threw that number into the new crop balance sheet, and then just about every number on the balance sheet they increased. Of course, the acres were up, the production's up. But demand went up as well. They raised feed demand to offset a little bit of this. I don't know where we're going to feed 6.1 billion bushels of corn. Cattle numbers really aren't going up, I don't think. I don't think people are keeping cattle. We're still seeing, a lot of selling of feeders at prices. Ethanol demand, I could buy that going up a little bit. This big jump in feed is huge. We're talking 425 million bushels higher than this year. We'll see. Export demand, I'm okay with that number. I think based on the sales we're seeing right now, that export demand could continue to be good. So total demand, almost 16 billion bushels. That's a record. So that's already in the balance sheet. And even with that, we're looking at stocks over 2 billion bushels next year. So what can happen going forward? I think a lot of people are going to lean towards probably seeing a little bit of a lower yield. Could you see harvested acres cut eventually? Maybe a little bit based on some of the issues we had down in the Mid-South early in the spring. But with some of those issues we had this year, and we still didn't see USDA, even kind of sniff at that here in these acreage numbers. So we'll see going forward. But the one thing that would be concerning to me is that they've already forecasted a demand of almost 16 billion bushels. That's already in the balance sheet. So to see that number get bigger, I think would be difficult to have happen. So we'll see. Maybe these yield numbers come down a little bit. We'll get Pro Farmers numbers next week. Average farm price at $3.90. That was down 30 cents from last month's report. We'll talk about that later when we look at farm program stuff. And how does it all match up when you look at stocks to use versus farm price? The inverse relationship really is strong in all of our markets. And you can see with stocks to usage bumping up to 13.3% now with this big crop, and price dropping down to $3.90. So just kind of tells us what we already feel. So looking at the stocks matrix, updated all the numbers in here. USDA says we're going to start at 1.3 billion. We're going to use close to 16 billion bushels of corn. And then you can see in the matrix, if we have USDA's acres, USDA's yield at 188.8, then 2.117 is our carryout. Okay, what else can happen? Well, I've got the June acreage number down here, it was technically June acreage number at the bottom. But you can really see that, if we're at 188 or above, we're looking at probably 2 billion bushels. If yield were to drop down into the 187, 186 area, now you may take ending stocks down a little bit below 2 billion, given that strong demand number. So to get bullish, you probably have to take yield down to, 185. You start to get stocks maybe back under 108. That probably gives the market a lift. So we'll see. Again, the Pro Farmer Tour next week, I think, is going to have more weight than it normally does, just because of how large this increase was in this report. To get down into the gray numbers, you're probably going to have to cut acres and yield. I don't think the yield at this point is probably going to go down that far. So, you'd have to cut, yield to 185, maybe harvested acres, you chop 1 million out. Now you're down to 1.6, something like that would get the market kind of fired up a little bit. So the demand side of things in corn, it's real. If you look at our commitments so far, this current marketing year, and this was before the report yesterday, but we're above USDA's target. And that's why USDA bumped the old crop export demand number in yesterday's report. And this will run through the end of August. Next year, though, our sales year to date are fantastic so far. We're running at the second highest level in history so far with new crop sales. Only 21-22 is above it. And that year we had China buying U.S. corn. China's not buying any U.S. corn right now. So if you take China out of the equation, we're still seeing a really strong period for sales. And I can't remember. I can't see the top of my chart here. I apologize. Well, let's skip ahead to the next one because I think it's the most important. Looking at the world numbers, when you look at stocks to usage at the world numbers, the major exporters. So we're talking about the United States, Brazil, Argentina, Ukraine, although Ukraine's not much of an exporter at the moment. Historically, they have been. But Brock had put these two charts out the other day, and they said, if we had a 185 yield, here's what our stocks to usage looks like. And the reason that's important is that our stocks to use had been falling back pretty sharply here in 24, 25. It's going to go up this coming year. With a U.S. yield of 185, we would basically go back to where we were the year before. If you take that yield up to 189, now you're back up around 10% stocks to usage at the world level. So you've eliminated some concern, partly because we had a record Brazilian crop. You double that up with a record U.S. crop, and now all of a sudden you've built world stocks back to a pretty good level. So here's where the funds were at as of last Friday's report. Yesterday, I think I saw they had sold about 20-something thousand contracts of corn. So, the only time they've been shorter at this time of the year was last year. Last year, the funds made their record short by late July. They started buying it back at this time of the year last year, but it was offset by heavy farmer selling in August last year. And eventually we made our lows in about the third week of August. So they were net sellers yesterday. Today, the market's kind of quiet at the start. We were up a couple pennies. So maybe they've got all they want sold here for the moment. So as we look at December corn, got a lot of lines on this chart. I had a downtrend line that we had started back in April, and we had tested it several times. Drew another downtrend, steeper downtrend line here after the last few days when the market had attempted a rally and failed again. Yesterday made a new low at 392, kind of bounced back a little bit here this morning. I've updated the chart here after the opening here this morning. We were about 396 and a quarter, so pretty quiet trade. If you look at the times where we've had what I would call a hot market, the RSI at close to 70, stochastics up into the 70s, 80s, we haven't had corn in the hot zone since back in April. So this is the second year in a row that we did not get that June, July rally that we all kind of historically count on. Best you can, we pushed up against the trend line a couple of times, weren't able to push through it. So what stands out here is the insurance price at $4.70. We'll talk about that here in a little while as well, but at least if, depending on what your level of coverage was this year, if you've got some coverage using that 470, that looks like a pretty good move. If we're able to get any kind of upside, where are our resistance? First of all, this trend line, which is just above $4. The next trend line's up around what, 4.25 to 430. You've got this chart gap that we never quite filled. Got to 430.25. I think 433 is the top of that gap. So I would hope at some point in time here before expiration that we could run back up and try to fill that chart gap. To me, that would be a great target for us to short the corn market if we get back up to that level. So we'll see if it can happen. That would be just below the 100-day moving average line as well. Today, of course, I don't think any of us want to be a seller. RSI at 34, stochastics down into the teens, probably a time to be sitting on the sideline and let your insurance could basically provide some protection here at the moment. If I did have to liquidate either old crop corn, you could always buy a callback against that if you want to re-own it. But it just not the time you'd want to be a seller here or go short the market, I don't think, here today. So historically, you look back to last year, a lot of comparisons to a year ago. And, last year we made our low here about the third week of August. That feels like we're kind of doing something similar right now. We've thrown as much bearish news at the corn market as we could here this week. So we'll see what happens in next week's, again, Pro Farmer Tour. The other thing I want to look at in corn is the carry in the market, and this is very similar to a year ago as well. The carry is telling you to store corn this fall. Of course, I think we're all probably in the mode of wanting to do that, but this thing has continued to widen. It's going to continue to widen, I think, here as we move into fall. We're about 37-cent carry from December to July. So what do we got? 7 months. Divide that into that. What are we about five, a nickel a month at least. So, that's pretty decent carry in just the futures market. You throw basis in on top of that. I imagine the cash carries are pretty wide right now. So we'll look at beans here in a minute, but I think I feel the same as last year. If I had space, it could be one or the other. I would probably want to get rid of my beans and store my corn. That's kind of what the market's telling us. And I tend to think from a cash standpoint that we should have some better opportunities into 2026. And that's probably easy to say given where the market's at today. But I've said it a week ago, too. I guess I just feel like that with fertilizer prices where they're at, that I would tend to think that we're going to see a lot of these swing acres that went to corn this year probably swing back to soybeans next year. The states that had the biggest percentage increases this year in corn acres were the Dakotas, Nebraska, Kansas, Mississippi, Louisiana. So a lot of our acres that had been heavy beans last year went to corn this year. I tend to think that based on prices at the moment, you'd see some of that swing back to beans next year. And so we'll hit on beans in a minute, but I would tend to think that would give us maybe some opportunities to market corn down the road. The other thing to consider, I think, on corn this fall might be the loan program. It's not great, but under the One Big Beautiful Bill, the corn loan rate went from 220 to 242, so it went up 10%. I know it's not great, but it's 22 cents better than it was. So if a guy needs cash, might be a way to generate a little cash flow here this fall and still maintain some ownership if you got storage to do it. Soybeans, the report yesterday, just the opposite. USDA lowered bean acres about 2.5 million. Pretty big shock because we weren't expecting that big of a change in acreage numbers, period. But if you look at the planted number, this is the second lowest we've had since 2013 in bean acres. So, and we'll talk about beans here in a minute. We'll look at the balance sheet, but beans to me didn't have a whole lot of room to give if you just looked at the U.S. balance sheet by itself. Then you go ahead and subtract 2.5 million acres, and all of a sudden things change a little bit. Kind of the opposite of corn, the survey versus the June versus the final. You just don't see that big of a drop. We had it in 2019. Other than that, you just don't see this big of a move typically, especially to the downside. And so the bean crop rated well, 68% good to excellent. Not a record by any means, not like corn, but still a good rating on the bean crop. The yield, though, went to a record 53.6 in yesterday's report. So the first time in 4 years, we were back above trend line. And if we look at the state-by-state yields, similar to corn, the blue states are all above last year. The ones with a pound sign all were a record. So the I states, Minnesota, Missouri, Michigan, all had record yields. Arkansas, Mississippi as well. So some big numbers out there in several states. And production, because of the lower acres, production actually down a little bit from last year. So despite the big yield, and we'll see where the final yield comes in. August, of course, always a big weather month for beans, but the production number down a little bit. And when you look at versus trade estimates, the acreage number is what did this, but the final production or the production number from USDA well below all of the trade estimates. So therefore, bullish reaction by the market yesterday. So looking at the balance sheet, USDA did make some changes in the old crop side. They increased the crush, made a few tweaks here to seed and residual, increased exports, took ending stocks down 20 million bushels to 330 million. Plug that into the new crop balance sheet. With lower acres and even with a higher yield, production went down about 30 some million bushels to 4292. Exports, they did drop back a little bit to offset some of that. But ending stocks back down to 290 million bushels is not bearish at all. And in fact, I would think that it's a little bit supportive, and the market kind of reacted that way. You look back to the last few years, when we were below 300 million, you had what, $13-14 beans. So one of the differences now, though, is we've had back-to-back huge South American crops. So the world balance sheet has changed. We don't have China buying U.S. beans at the moment. So some of those pieces of news have been what's held the bean market back. Looking at the stocks to use versus farm price, kind of a sideways move here this year. Looking at the stocks matrix, if you want to be bullish beans, this could lay out reasons why. I consider anything over 300 million a very adequate number, and we're at what, 295 right now, given the current stocks, current yield and acreage number. But if you were to take yield back, under 53 bushels, and now you're down in the low 200s on ending stocks, given the current demand numbers. And so, if August doesn't finish well, if we are hot and dry the last half of the month, something like that, you could maybe paint a picture that's a little bit bullish beans, especially from where we're sitting here today. So it wouldn't take a whole lot. Or if something happens where acres go down, I can't imagine they would lower acres much more, but certainly you could paint a reason to be somewhat friendly. So new crop bookings, you can view this two different ways. Sales so far this year, hardly anything, and nothing to China so far. Now, you can say that's bearish. It's been bearish. Or you can say if something changes here, if we get a trade deal done with China, could beans rally $1? Yeah, I wouldn't rule it out at this point, because we don't have anything in here right now. And as bleak as it is, the market still was up 20-something cents yesterday. We were still up another dime this morning. So we're factoring in this lower production. If China were to come to the market, I don't think they're going to quadruple their purchases like President Trump said. And honestly, if you quadruple zero, you still get zero. So, that's the math doesn't work. But if they come in and buy anything from the United States, and they will eventually because they have to, they can't. Logistics just don't allow them to continue to buy everything out of Brazil. Brazil will eventually run out of beans prior to their harvest, so they will come back and buy some U.S. beans at some point. So I view this somewhat friendly here at the present time. And if you look at their imports, they're importing beans right now. It's not like they're not buying beans. For several months back, we were talking about China was having, their demand issues. They had some economic issues. They had hog feeding issues. That's changed. In the last 2 to 3 months, they've been very aggressive buyers. And so they're just not buying from us at the moment. But we'll see if that does change. Board crush. Just a different way to look at what's happening demand-wise in the United States with products. The crush numbers have been great. We're adding these new processing plants online, and they're blowing it out. They're crushing as many beans as they can right now, and rightfully so. If you look at the history or the prices between meal and oil at the moment, oil has been rallying, meal has been going down. We've said this before, but it'd be a great place, I think, to be feeding the hogs is right next to one of these new soybean processing plants, because you ought to be buying a lot of cheap meal, I would think. And if you look at the fund position in meal right now, they're holding a record short. So they've just kind of added insult to injury to what's already going on in the marketplace, that nobody wants meal. And that is so much different than when I started in the grain business, 30 some years ago. We crushed beans for the meal in the United States and couldn't get rid of the oil. And now it's just total opposite. Now we're crushing beans for oil and you can't get rid of the meal fast enough. And so you get a lot of cheap meal. The funds are short beans, not a lot. They were short about 70,000 contracts last week, which is the shortest they've been in a few months, but they bought back about 16,000 of it yesterday. So they're kind of hanging around neutral. And again, with ending stocks around 300 million, I don't know that I want to get too short beans if I'm a fund trader at the moment. So things were looking pretty bleak a week ago. Now with the changes in the balance sheet yesterday with the lower acres, all of a sudden the bean balance sheet doesn't look so negative. And so I could see these people continue to buy and back some of their shorts. So here's what's happened in November beans. Even before the report came out last week, we started to rally beans Monday, Tuesday, and then today. We've gone back up and filled this gap in beans, the July 4th gap, which we haven't in corn. That's my goal in corn to eventually go back and fill that. We did it today in beans. So that's one of our objectives. We've all of a sudden taken what was a bearish market just a few days ago, and now you've got stochastics up into the, nearby stochastics into the 80s, RSI at 63. We're not overbought yet, but we could get there pretty quickly. We've got a double top at 1074.25. Can we go back and challenge that? It's about 30 cents above where the market was at this morning. I would think that that's a reasonable objective. And if we do, then I think that's a pretty good selling target because you're probably going to be looking at an RSI in the 70s and stochastics, well up into overbought territory. So I think if you approach that, 1065 to 1070 area, probably be a good opportunity to liquidate to sell some beans. And if that does create some space to store corn this fall, then I think that's a good move. Or if it creates cash flow, I think that's a good opportunity to take advantage of. Looking at history compared to last year and corn, to me, it feels very similar. Beans, maybe we've made the low a little bit quicker here with this bullish report yesterday. So, but it's been a pretty flat year in beans, all things considered. We just haven't had a lot of movement. You get one piece of bullish news, but you offset it with a piece of bearish news out of South America and vice versa. So we just haven't been able to really get this market to move a whole lot. Looking at the carrying beans, we had pushed down to some pretty large numbers just a few days ago. The November to July, we were out over 60 cents. And now here we are into about 48 cents. So, you're 7 cents a month, a little less than 7 cents a month from November to July. But by the time you factor interest on beans, it's a lot more expensive than corn. So I don't think it's enough of an incentive to me to want to store beans over corn at this point, I guess. So I'm still thinking more towards the corn. The cotton market. Cotton was the other crop that had a big move yesterday. And if you start out looking at the ratings, it's still a good cotton crop, although the rating has started to slip just a little bit. But the big story yesterday, USDA lowered acres on cotton, like soybeans, lowered cotton acres to 9.28. I guess that's probably where some of the southern corn acres came from. Planted less cotton in Mississippi, Louisiana, and Arkansas, substituted some corn in some of those acres. Harvested acres at 7.36 million, pretty low number. USDA raised its yield to 862 pounds, but that's still the lowest we've had in 4 years. If you look at the state yield numbers compared to a year ago, kind of a hit and miss. The red states are down, blue states are up. We do have a handful of record numbers. North Carolina, Mississippi would have records. So, but overall, it's just pretty ho-hum as far as the crop goes. Good dry land numbers, I think, out of Texas. We've heard some good crop ratings out of Texas this year. So that's not been a story at this point. But cotton production at 13.2 million bales, the second lowest we've had in a long, long time. And so that's a bit of a surprise considering where we went into the year. And that number was way below any of the trade expectations. So pretty bullish, but it only lasted one day because the market was down this morning. But here are the numbers in the balance sheet. USDA raised its exports for old crop cotton 100,000 bales, took stocks down to 4 million. On the new crop, we lowered acres, we raised yield, but production was down more than 1 million bales. which is huge. USDA also lowered exports slightly, which took ending stocks still down to 3.6 million bales. So it was initially a little bullish. Average farm price went up a penny to 64 cents. And as you look at the matrix, here's where we are at 3.6 million bales. If you want to get bullish, get down into the red numbers, you either A, have to take harvested acres down a little bit, and or B, take the yield down maybe to 830. Now you can dip into below 3 million bales. So we'll see what happens eventually between now and harvest. I saw this chart the other day. I thought it was interesting that showed that the reliance upon exports, of all of the crops in the United States, percentage wise, cotton is the biggest. 84% of our market is reliant upon exports. So cotton price goes as the export market goes. And it seems like the stock market tends to resemble that as much as anything, or the Dow does. And so cotton tends to follow the Dow, but it also follows exports, follows Chinese economic trends, Indonesian economic trends, other Asian countries that are buyers of cotton. So thought this was interesting. You can see some of the other crops on here as well. You get down to soybeans, 47%, wheat, 46%. We export a lot of those crops. Corn, historically not as much. We use a lot of it at home, but that's growing here as exports grow. So cotton, the funds right now are short about a little over 50,000 contracts. So they've built a big short position, bought some of that back yesterday after the report. And in fact, after making a new low last week, we had rallied a couple of days, got above the 100-day moving average yesterday. Life was good. And then we traded back lower again this morning in cotton. So cotton guys just can't really catch a break. We got back within 3/4 of a cent of the insurance price, 69 cents. We haven't been above the 200-day moving average since sometime back in 2024. We just can't really get anything built here. So we've had 0 days of the RSI touching 70. This market just can't seem to catch any breaks. So as far as the selling target, the 200-day moving average, I think still remains a target to the upside. Here today, probably want to sit on my hands with the market back down. And then finally, wheat. The winter wheat numbers, yesterday's report versus last month. Wheat, we have been getting updated yield estimates. The ones with the pound sign are records. So Missouri, Illinois would have record yields so far forecasted. Michigan, 91 bushel wheat up in Michigan. Texas at 37 is a big deal. Been getting rain down in Texas this year for the first time in a while. So all the dryland wheat having a good year as well. Winter wheat production at 1.36 billion bushels, the highest since clear back in 2016. Looking at spring wheat numbers from yesterday's report, the red and the pink down, the blue up. So a rebound this year where it had been very dry in Montana, Idaho last year. The upper Midwest states down a little bit from a year ago. And spring wheat production, the lowest it's been here in a few years. So when you throw it all together into the balance sheet, really wheat was kind of a nothing report yesterday. We saw a lot of tweaks to some of the numbers. The biggest change was in exports. We went up 25 million bushels. Ending stocks dropped just a little bit yesterday, but it was a very nominal drop. Average farm price fell a dime to $5.30. At the end of the day, wheat followed the corn market down yesterday. That was probably all you can say about wheat. Exports have been pretty good. I know there have been some rumors going around. Exports had not been that great on wheat, but we've been shipping some wheat. We've been selling some wheat. Ukraine's kind of been off to the side as far as being able to export wheat. I did see some stories. I think I got it here. Talking about Black Sea wheat exports, the lowest since 2017. I did see a story. They said Russian wheat acres increased yesterday, but then they said those increase in wheat acres was all Ukrainian acres that the Russians had taken over. So you kind of got to lump those two together when you're looking at the numbers to paint a correct picture. But the fact that their exports have been down has been a help to the United States. Chicago wheat. The funds are short about 80,000 contracts right now. So the most they've been short on this particular date Again, I think following what they're doing in the corn market. As you look at September Chicago wheat futures, we're hanging right around a contract low at the moment. Not a lot of life here. Nobody's wanting to buy fresh new crop wheat at the moment, soft red winter wheat at least, and the RSI at 32, stochastics even moving down in single digits. So very, very oversold market here at the present time. KC wheat, very similar, pushing down near a contract low around $5. So, what kind of a bounce back do you get? This 9 and 20-day moving average lines, we really need to take those out before you can get serious about a whole lot. Minneapolis wheat funds are short spring wheat over 20,000 contracts. So similar to last year, similar to 2020. And if you look at the chart here on Minneapolis wheat, again, kind of like the other ones, we're hanging near a contract low here at the moment. We haven't really had a good time to sell wheat. Maybe back in June, you had some pretty good opportunities with the RSI building. But besides that, it just hasn't been a good year for wheat. So looking ahead to new crop, what are we going to have this next year? We're going to start setting our base price for next year's winter wheat for insurance this Friday. Not a good time to do it. 565 and a quarter this last night's close. So, it's not going to be very attractive. I would tend to think, wheat acres will be down a little bit. We'll see, unless people are planning on a combination of wheat and beans, which might be attractive, I guess, given that bean prices are coming up a little bit. Maybe you're going to see a little bit more of that intention this coming year. So we'll see. I skipped over all the world numbers for the most part today because I wanted to really focus on the U.S. and we really didn't have any changes to the southern hemisphere crops. But when you look at world ending stocks from yesterday's report, corn went up 4 million tons. That was all from the United States. Beans went down about 2.5 million tons. That was all from the United States. And wheat was down a little over 1 million tons yesterday. So, but all in all, the world numbers didn't really have much impact on the markets. Quick glance at weather, where are we at today and how did we get here? The drought monitor for August 5th looks about as good as I think it's ever looked. It's just incredible. And so I know there's a lot of people on social media that are saying, the roadside crop tours look tremendous. The vegetative health looks tremendous. If you look at the percentage of corn and drought, only 3%, cotton only 3%. I don't know that that's ever happened, that we've only had 3% of the cotton area in drought. Soybeans at 3%. So it's an incredible year from a vegetative health standpoint. How does that translate into crops? How does it translate into grain? I guess we still have to wait and see how that is when we get into harvest. A lot of people are telling me they don't think the crop is as good as the satellites dictate. We'll find that out here in the next couple of months. As we look ahead over the next few days, the next 7 days, we got some rain in the northern belt, rain in the southeast. Otherwise, pretty spotty across much of the country. The predicted change in soil moisture over the next 2 weeks. We're going to start to dry things out in the Mississippi Valley, which will kick off harvest very strongly. Louisiana, Mississippi, Arkansas. We're going to maybe be concerned a little bit about late season dryness in the eastern belt up here because it's been dry there for a while. But, late development of soybeans in Iowa, Minnesota, the Dakotas, just looks pretty darn good right now to get some rain here the rest of the months. So all in all, pretty good forecast. Looking out into fall, maybe some concern about getting wheat established out in the plains. You get September, October, November, we're still looking at below normal precipitation. However, I guess I would offset that by saying this is the same map that they were telling us last winter that we were going to have all through the growing season this year, and it really never happened. So that's the second year in a row that we've had a very wet drought out in the western corn belt and the plains. One of the wettest droughts we've had in a long time. So I take this a little bit with a grain of salt because their recent history has been pretty shabby. But this could eventually have an impact on getting some winter wheat established. So maybe give the winter wheat market a little bit of a boost at some point. So we've talked about grain markets a lot. We want to cover some of the other pieces of the triangle as well. Let's start off looking at farm programs and what we know about some of the programs right now. I do not want to be an expert on the supplemental disaster relief program because, I know that the government sent letters out to a lot of producers telling you that, you may or may not be qualifying for a payment and really didn't give a whole lot of instruction with it. The one thing we've learned in several areas is that if you're not in a county that had a D2 drought, that don't put drought as the reason that you had a loss last year. So if you did have a loss, it had to be from something else. If you want to get a payment, a lot of folks have put derecho or wind or something like that as a reason, and some of those have been paid. So far, these were the payments that had been made through August the 3rd. I can't remember what the number was of total dollars that was available in this program. I think it was over 20 billion. So I know they're just getting started making payments. This is phase one. Phase two is set to take place in September. And phase two, then, I think is going to incorporate some shallow losses and some of the insurance programs like margin protection and ECO and SCO. Some people may get letters then in September that would say you would also qualify now for a payment. This first round of payments, they only paid, I think, 35% of what the calculated payment amount was going to be. I think they wanted to see how many dollars would get paid out this first go around in phase one and how many dollars they had left then in September for phase two. So if you didn't get a letter for phase one and you had a high coverage, whether it was ECO, SCO, margin protection, you might get a letter then in September for phase two. So we'll see what happens. These programs were set up basically for hurricane, wildfire, et cetera, a few years ago. They've continued to add some money to the program. So we'll see what happens as we go forward, try to learn about it as we can. The other big news here in the last month has been the passing of the One Big Beautiful Bill. And it had a lot of stuff in here for agriculture. Now, we haven't officially signed a new farm bill yet. There's talk that we could get what's called a skinny farm bill this fall. There's some other things that were outside of Title I, which is what we're looking at here. Title I is the FSA stuff with PLC and ARC. Title 11 is our crop insurance, and they've made some changes to that we'll talk about in a minute. But there's some other stuff like conservation and this and that haven't been passed. And so as of the moment, we don't have a new official farm bill. That could happen this fall, although I'm hearing that it might be into 2026. So implementation of some of these programs right now is still a bit of a question mark. But you can see here, this shows how the dollars would be kind of split up into some of our crops. We'll talk about the PLC program here in a minute, and it looks pretty favorable, some of the changes that we've seen here from where the markets are at right now. So here were some of the highlights of the One Big Beautiful Bill, or the OB3, I guess some people call it. It raised the PLC reference prices. It raised the PLC effective reference price. So in other words, if the ARC benchmark price gets enough higher than the PLC price, ARC benchmark is a 5-year Olympic average. And if the ARC price exceeds PLC's reference price, then the PLC effective reference price will kick in. And that's 88% of the ARC benchmark. We'll look at that here in a minute. The ARC county trigger went from 86 to 90%. The ARC county band of protection, it used to be a 10% band, so it was from 86 to 76. Now it's a 12% from 90 to 78. For 2025, all of us went and signed up for something back in March. You had to go make an election between PLC and ARC. Forget about it, because under the One Big Beautiful Bill, you're going to get the higher of the PLC or the ARC payment for 2025. So I know a lot of people were fretting about which one would be better, worse, whatever. Because they made this change effective for 25, you're going to get the higher of the two. Starting in 26, we will have to make an election again. So in March, we're going to have to step up and say, do I want PLC or do I want county ARC? We're going to add up to 30 million base acres. This has been something a lot of folks in parts of the country have been clamoring for a while, especially with all of the new broken land that we had over the last probably 30 years. You look at a state, I always talk about Missouri, northern Missouri especially, but you had a lot of pasture ground across northern Missouri 25 years ago. And now it's a lot of corn ground across northern Missouri, but it doesn't have any base. A lot of that acreage is going to be allowed to update or to add base acres and be able to participate in the programs. We don't know the details and exactly where that's going to be yet, but that's good news. We're going to see an increase in the entity payment limit from 125 to 155. The SCO trigger for crop insurance used to be 86%. It covered from 86% down to your individual level. That's going to bump to 90%. And the subsidy for SCO is going to go to 80%. So SCO is going to resemble the STAX program for cotton. This is a big, big deal. It'll be a huge deal. We'll talk about it for spring crops later on in the winter. For winter wheat, we don't know yet if it's being implemented or not. It hasn't been added to the actuarials yet by the RMA, so we'll see here over the next few weeks. ARC County is allowed with SCO. I know this has been a big deal over the last couple of years that we've had to make a decision every year. Do I sign up for ARC County? And if I do, then I cannot buy SCO. Or do I sign up for PLC, which allows me to buy SCO? You're not going to have to worry about that anymore because they're going to allow you to do ARC County and buy SCO, which is a big deal because of what I just pointed out, that SCO is subsidized at 80%. So it's a county coverage from 80 down to your individual level. So there's going to be a lot more flexibility under this big, beautiful bill in what we decide to do. One last thing, beginning farmers and ranchers. That program was a 5-year program. It's expanded to 10 years. So some of you may qualify for added discounts if you've been farming less than 10 years. So make sure you bring that up to your crop insurance agent. So how does it all impact us as we go forward? Well, these were the new reference prices for the PLC program. In the past, corn was $3.70, bumps up to $4.10. Soybeans, I don't remember what it was, $8.90. It's going up to $10. All of these numbers are much bigger than what they had been. Honestly, when they started talking about raising these PLC prices over a year ago, threw out some numbers. I didn't think that would get done. I thought there is no way under the Congressional Budget Office will score this to where they're going to let it get done. It eventually took having a Republican president, a Republican Senate, and a Republican House, and a president that told them to pass it to get this done. And so I don't know how else you would describe it or how else you would explain it. So we've got these bigger numbers. The ARC numbers for this year didn't change. These are still 5-year Olympic average prices, 503, 1217. These are the numbers we looked at back in March before we signed up this year. A lot of people signed up for the ARC program. The new effective PLC reference price is going to be 88% of this ARC price. So that's going to bump to 442. So and because the government says now you're going to get the higher of the two, you're either going to get the ARC payment based on 503 at 90% or a PLC payment. These are the current prices over here in the gray box. These are the current market year average estimates for the 25-26 year. USDA just had these in the report yesterday. They've dropped the corn from 420 to 390, kept beans at 1010, dropped wheat, dropped sorghum. Every one of these numbers in the gray box is below this light blue box, which means every crop right now would qualify for a PLC payment. And as you look at corn, 52 cents a bushel. Right now, that would be 52 cents times your payment yield that's established at the FSA office. You did that several years ago. It's well below what you raised now, I know, but that's what was set back in, I think, 2014 maybe. Times 85% of your base acres is what you would get paid on. So as of today, if the markets stay where they're at, Now, the marketing year for 25-26 starts September 1, ends August 31 of next year. So we haven't even started the marketing year. Payments for this year's crop wouldn't get paid until October, November of 2026. So don't spend it yet because it's still over a year away. But if the prices stay where they're at, every one of these crops would be triggering a PLC payment for this next year. So I'm not sure the government knows what's going to hit them potentially, but that's what they wanted. They were trying to figure a way to help producers in a situation right now that we're in, where inputs are up, prices are down, margins have tightened to historic levels, and the programs look like they're set up to do that here for 25. The ARC program may end up triggering a payment. We'll see, depending on your county yields, because it's a revenue payment, or a revenue program. So we're going to have to take, your final county yield times whatever this final price is, and compare that to the ARC benchmark. This price times your county's starting yield, and so that's a revenue program, and we won't be able to do that until next fall either. So, but as it stands today, both programs look like they're in the money. At least the PLC program looks like it's in the money. Then I had the crop insurance price over here to the right, because we were looking at SCO versus ARC last year, and SCO was at 470 and ARC was 503. And so that's why ARC looked attractive. And so going forward, we're not going to have to do some of that. So crop insurance for 2025, we've set our final prices for winter wheat. You can see what those were for the crop you just harvested. We ended up down about 9 to 10, 12%. So depending on your coverage level, most likely you would have had to have a loss in bushels to trigger a revenue loss in wheat, depending on what coverage you bought. For some states and some crops, we're in the middle of setting prices right now. Spring wheat states all across the northern tier, barley, those are being set. Oats are being set. Sorghum and corn in the some of the southern states are setting their prices today, as well as rice. You can see the percentage drops so far. So, depending on what, these final percentages are, will determine whether we would have to have a yield loss or not in order to get a revenue payment for this year. The one program I do want to look at pretty hard again is ECO. I did a Thinking Cap video on this a while back on where ECO stands, and I still think that ECO is we did this back in February. A, because the price was 470, but B, because we told people that if you don't know if you're going to be able to sell any crop at some point, we haven't sold any yet. At least with ECO, you've got a 95% trigger. It's a 9% band. At least it was for this year. So from 95 to 86, and at least it gives you some top end coverage. You don't have to get down to 85 or 80%, on your RP to have a payment, because for most people that puts you well into the red on your farm. And so we at least wanted to be able to get some of that top end coverage. And so this is an example for Shelby County, Indiana, as of last night. With a $3.95 December corn price, we would take the higher of the two prices times your APH to determine the crop value times the 9% band, which means that band is worth $84.60. If you bought 100% of that band, that 9% band is worth about $85. I backed into the math here to be able to show where you would get a payment on a county yield. And at the current price, this county would have to be below 222 in order to start to trigger a payment, which historically they've never been that high. Then we can look at the matrix. If you look at this is the worksheet. If I toggle down and look at the matrix, Shelby County's highest yield ever has been 205.6. Even if they come in at 210, you're looking at a payment of about $50 an acre right now at 395 corn. So this is where I'm saying to folks, if you've got ECO, margin protection insurance, something with a 95% trigger, I don't think you need to go out and panic sell at the moment, unless you just have to create bin space or something this fall, because you've essentially got an in the money put option right now. And even if the crop yield is, and I started this at 100% of expected county yield here on the left and went all the way up to 112 on the right, but at 395, we're looking at a payment even at a 220 yield in Shelby County. And so if the market goes down from here on corn between now and the end of October, we're still protected. If it goes back up 30 cents and we fill that chart gap, well, then I probably look at selling some corn. That's kind of the way I view the corn market at the moment, depending on your coverages and where you're at right now. So that's why I don't want people to panic. I want you, this was the reason we did this. Because quite frankly, we figured we couldn't afford, a 15 or 20% loss in revenue before we would start to trigger a payment with one of your other policies, with RP insurance. And so this at least filled that dollar gap at the top end. And we don't want to be in a situation where we're going to collect, but at the moment, we're sitting there today with that bearish report yesterday. As of right now, a lot of us would be looking at getting an ECO payment, and a lot of us would be looking at getting a PLC payment from the FSA office next fall. So, we've at least got some protection here on price at the moment. So it's maybe not as dire as what it might seem. Looking ahead to 2026, we've got some changes. One of the immediate changes, we're going to talk about some of the other stuff, SCO and ECO and some of that into the winter. But one of the new programs we have available is MCO, which is margin coverage option. You can see for corn and soybeans, here's a map where that's available this year. MCO, it was described to me by the guy that developed the program. He said MCO is like margin protection and ECO had a baby. And it took it took parts of both programs. The margin protection program, what it took from margin protection is this pricing window of August 15 to September 14, and it does use input costs in order to determine a margin. So it is a margin-based program. Unlike margin protection, it's a banded program. So like ECO, it's 95 to 86 or 95 to 90. We don't know where the bottom is going to be yet, but it's going to be a band of coverage. So it's not covering from 95 down to where your individual policy left off. Therefore, it's going to be a lot cheaper than margin protection was. So it's got some of both in it. Here's a snapshot of what the website looks like where we're going to quote it. Under the big, beautiful bill, we mentioned earlier, SCO is going to go up to 90%. So we think margin coverage option is only going to be 95 down to 90. But the government hasn't done it yet. So we think the FCIC apparently was meeting this week. And we think coming out of that meeting, they may see some of the changes made. So while this program was written back when it was an 86% top for SCO, now that SCO has changed, we think this is going to go from 95 to 90, hasn't been established yet. So how does it work? It works a lot like margin protection did. It will use inputs for urea, DAP, diesel, and potash. It will not have diesel, which margin protection did. It will not have interest rates that margin protection did. The potash contract under MCO is a moving price, so unlike margin protection. So there are some differences here. It does not have a fixed input cost. So we're just looking at these four individual variable inputs for the MCO program. So compared to margin protection, there are some differences. I mentioned a minute ago, the subsidy is a big one. MCO is going to be subsidized at 65%, which is what ECO is subsidized at as well. Margin protection is only 44%. So that's going to make MCO a lot cheaper. Margin protection has a protection factor. You can buy up to 1.2. MCO does not have that. So there are some differences here. Bottom line is MCO is going to be a lot cheaper, but it's going to cover less dollars. It's going to cover a 9% or a 5% band at the top. So this is what shows how it's going to work. And this is what we anticipate some people doing this year. Buying individual coverage next year up to whatever percent. You can buy it as high as 85 on an RP coverage. The next band above that will be the SCO, which I think is going to become a lot more popular for 2026 because of the added subsidy. Going up to 80% subsidy, it's going to make SCO cheap. So a lot of people are going to buy individual coverage up to, say, 80, 85, 75, whatever level, maybe do SCO from there up to 90. And then you could do either MC margin coverage option or ECO in the spring, depending on whether it makes sense to lock something in now or whether I want to lock something in February when that price is set. And so this chart just kind of shows some of the differences between them. Basically, the biggest difference is the pricing window that MCO is pricing now, ECO and SCO price in February, and MCO does include input prices in its math. And so does it make sense for me to do it today? I think that's the big question for MCO. Well, for beans, all of a sudden now you got a bean rally. You're over to 1073. Is it going to make sense? We're going to start setting the price this Friday, and we're going to run through the middle of September. If you were to get this bean price up to $11, I don't know. Might want to take a look at it. We'll discuss that here as we go forward. We haven't reached the starting point yet. Because if I think that $11 beans is going to buy a bunch of new bean acres next year, all of a sudden, if we add 5-6 million bean acres next year, maybe it makes sense to either A, go ahead and forward sell beans at $11, or B, maybe I want to look at MCO. We'll see. For corn, just kind of the opposite. At 445 right now, I don't get too excited. Now, the only reason I do get a little bit excited about corn, and we'll talk about it in a minute, is the carry in the market. You got 445 now. Corn today for 25 is at 395. So you're getting the opportunity to lock something in 50 cents higher or 45 cents higher than where the current year's market is. So I don't think I get excited about it. Kind of where we were last year. We were at 440 at this time. It was what the average was. So I don't think I'm excited about it, given the fact that the funds are short, how oversold the market is, but we'll see where we price at. Historically, the August-September window has been favorable for corn, has not been favorable for beans. You can see 8 out of the last 19 years, it's been the higher average versus February and October. However, if you average out the prices, February's actually been a little higher than the August-Sep. But we've had more years where for corn, this has been a good deal. Beans, not so much historically. One of the reasons where I might not want to do this year is going to be these input prices. When you lock in margin coverage, you're locking in a margin. Well, we could probably figure on a cocktail napkin that margins are not real good right now. We know where input prices are. DAP price versus corn ratio. Josh Linville with StoneX put this on Twitter the other day. It's at a record high right now. DAP versus corn price. Urea's high. Potash is high. So to lock in margin on corn today doesn't seem real attractive. And if I do this, I'm counting on, margins. For it to essentially pay, the margin's going to have to get tighter. And so, how would that happen? Corn go down and fertilizer go up. But if it's already tight, it may not be that attractive. And so we've developed a worksheet and a calculator for MCO, which we're still waiting to release because we don't know the final details of the program yet. But here are the inputs. As of yesterday, I had a 445 corn price. Urea was priced at 427, DAP at 680, potash at 478, diesel. Natural gas is only used for irrigated. So if you're non-irrigated, you're only using the top 4. In Tipton County, Indiana, those expected costs were almost $200 for this program. Last year, I went back and looked at what they would have been. Last year, they were $144. So your margin this year is essentially $50 tighter than what it was a year ago. It made more sense last year to do it than it makes sense for me to do it this year. So in order to see that margin tighten or to trigger a payment, you'd have to swing some things. Now, this is what the worksheet looks like. And if I think corn's going to $4 next fall versus 445, and if everything else stayed the same, let's say our input costs start at $199.75. Let's say they end at $199.75. I would end up triggering a payment of $53 an acre. And that's with this 9% band. Now, if the band is only 5%, it may not be quite that big. But just that drop in price, it's well over a 5%. That's a 10% drop in price, a little more than a 10% drop. So that's what would trigger the payment if the inputs stayed the same. So if you're looking to lock in price, and you think inputs are going to stay high, and the final inputs get set in April. So if you think inputs are going to stay high between now and April, then maybe it does make sense. And if you just want to have something locked in, if you're trying to go to your lender this fall and get operating money, and he said, what do you got locked in for next year? And you say, well, I don't have anything sold for 26. Maybe this is at least something you could do to get a portion of price locked in, to at least have something in place. We got the matrix here. We're going to have it available as well. So you can kind of see if the inputs don't change. Now, the matrix assumes inputs don't change, but if we end up at 220 yield in the county at 445, you would start to be triggering some payments. So we've got some time to talk about this. We got about 6 weeks before the end of the sales closing period. Again, we don't even have the final parameters of the policy, but we at least wanted to mention it because it's coming up fast. And so that we're going to have it, we're going to be talking about it as we get these final parameters. I'll be doing some videos and doing some more talking about it as well. So I put this together, just a question, in my mind, I had to come up with the reasons why I would want to do one or the other. So I put this together. Do I use MCO or wait and do ECO? I guess I didn't mention, but you can't do both. Both of them are essentially the same coverage. They're 95% down to whatever that bottom limit is, wherever the SCO is. So do I do this now or do I wait until spring? Well, one of the reasons why I would want to do it is take advantage of that higher back end of the carry price. D's 26 corn, if I compare D's 25 to D's 26, it's a 42-cent carry right now. So I get the opportunity to lock in D's 26, 42 cents higher than where nearby corn is. And if I think a year from now, we're just going to continue to ratchet this low price forward like we've done the last 12 months, then maybe locking that higher price in makes some sense. Beans, similar situation, 43 cents, although the carry's starting to narrow. Reason not to do it, the funds are big time short the corn market right now. If you look at their net position in corn, they're short 200,000 something contracts. Beans, they're getting back closer to even at the moment. So maybe that's not as big a deal, but I would rather be a seller or lock in a short type position when the funds are long, not when they're holding big shorts. We mentioned the margins a minute ago, compared to last year, that's a bad deal. Both of these have 65% copays. Both of them are banded coverages, so that's not a difference. So I'm really comparing, to me, do I lock this in today versus do I wait and do ECO in the spring? That's the big question. We've got 6 weeks to answer it. So you got some time. We'll be doing another one of these aftermath meetings in 4 weeks. So we'll be able to look at the prices then and see what we think. So, and again, I'll be sharing more of this as we get more details. So with that, coming up the next several days, we'll start setting fall prices here on August 15th. This will be for winter wheat. This will be for the margin coverage option for margin protection. We still have margin protection available, so we'll start to be able to quote that probably next week. Labor Day is September 1. Markets will be closed September 12th. By the way, next week is a Pro Farmer Crop Tour as well. So I should have put that on there. It might be something worth watching. September 12th is our next USDA report, which should have more information on yields by then. September 15th, we'll have our next aftermath. The 30th, we have a quarterly grain stocks report. Our crop insurance deadline for fall policies is the 30th as well. And then we'll do it all again in October. So with that, I thank you for joining this month's aftermath. Hope you have a good month ahead. I know we covered a lot of stuff. If you got any questions, feel free to shoot them at me, and we'll look forward to visiting again real soon.